What if I told you the free market was never actually free? What if the rules that protect your money today only exist because somebody somewhere got robbed in broad daylight and enough people finally got mad? That's not a conspiracy theory. That's just Wall Street's real history. And once you see it, you can't unsee it. A market without rules is not freedom. It is a hunting ground. That may sound harsh, but history is not gentle on this point. Every major rule in the stock market has a scar behind it: a crash, a fraud, a manipulation scheme, a panic, a group of insiders who knew more than everyone else and used that advantage until public trust finally snapped. The rule book wasn't written by philosophers debating fairness. It was written after people got wiped out, after prices were rigged, after companies lied, after insiders sold dreams to the public and walked away with the cash. Markets didn't become transparent because powerful people volunteered transparency. They became transparent because secrecy got too expensive for the system to survive. Before, before the modern rule book, Wall Street was a rougher place. In the late 1800s and early 1900s, the market was run by bankers, railroad men, speculators, pools, and operators. If you were an ordinary investor, you weren't playing the same game. You didn't have the same information, the same access, or the same protection. You were the last person to hear the story and the first one left holding the bag. Take the railroad era. Railroads were the great technology of the 1800s. They connected cities, moved goods, opened markets, and transformed the country. But they also became the perfect vehicle for speculation. Men like Jay Gould understood that controlling information and market psychology could be just as profitable as building anything real. Railroad stocks were pushed, cornered, and fought over by insiders who understood the game far better than the public did. The pattern was simple. A powerful group would quietly build a position, rumors would spread, demand would rise, the public would see the momentum and rush in, and the insiders would sell into that excitement. The public thought it was buying opportunity. Often it was just buying someone else's exit. That wasn't a clean market. That was choreography. Then came the stock pools of the 1920s. A pool was a group of traders who teamed up to move a stock, buying together, faking demand, spreading favorable rumors, luring in outside buyers, then unloading their shares at the top. The price looked like information. It was theater. A market price is supposed to tell you something about value. Manipulation turns it into propaganda. There were also bucket shops, where people could bet on stock prices without ever owning the stock. They looked like investing houses. Many of them were really gambling rooms dressed up in financial language. Customers thought they were joining the great American wealth machine. In reality, they were betting against operators who controlled the game and profited off the public's hope. That's the first lesson. Before markets had rules, the people with information and access didn't create fairness. They built systems to profit off the people who didn't have it. Then came 1929. The boom of the 1920s wasn't built on optimism alone. It was built on leverage. Millions of Americans bought stocks on margin, putting down as little as 10% and borrowing the rest. One real dollar could control $10 of stock. When prices rose, it felt amazing. Your gains multiplied, your neighbor got jealous, the whole country looked rich. But leverage is financial gasoline, great in an engine, catastrophic in a fire. When prices fell, brokers issued margin calls. Investors who couldn't pay up had their stocks sold automatically, which pushed prices even lower, which triggered more margin calls, which forced more selling. The market didn't just fall, it started feeding on itself. By the time the crash hit, people realized the wealth they thought they had was sitting on borrowed money, weak disclosure, insider advantage, and blind faith. The crash wiped out savings, jobs, banks, and the illusion that Wall Street could police itself. That's why disclosure rules were born. The Securities Act of 1933 was built on one simple idea. If you want to sell securities to the public, you owe the public the truth, not a polished pitch, but real information. What a company owns, what it owes, what risks it's facing, what you're actually buying. That sounds obvious now. It wasn't back then, when promoters could sell shares to people who were basically buying blind. And when you're buying blind, whoever's holding the flashlight sets the price. Disclosure didn't kill fraud, nothing does. But it flipped the principle. public money now required public facts. The market didn't invent transparency on its own. The crash forced it to. Then came the Securities Exchange Act of 1934, which created the SEC. It wasn't created because Wall Street was running smoothly. It was created because the market had embarrassed itself in front of the whole country. The Pecora hearings exposed conflicts of interest, insider deals, tax dodging, and preferential treatment at the top of American finance. They confirmed what people already suspected. The market hadn't just failed by accident. It had been shaped by people who profited from keeping everyone else in the dark. The SEC became the referee because the players had already proven they couldn't be trusted to call their own fouls. Self-regulation sounds great until the people regulating themselves are also the ones cashing the checks. The 1934 Act also gave the government real power over exchanges, brokers, manipulation, and how public companies reported their numbers. This wasn't anti-market. It was pro-survival. A market can't work if ordinary people believe every price is rigged and every insider is holding a marked deck. Then came margin rules, built on the same lesson. Borrowed speculation can turn an ordinary dip into a full-blown avalanche. The rules weren't trying to kill risk. They were trying to stop forced selling from dragging the whole market down just because too many people had built their portfolios on debt. Again, the rules showed up after the damage was already done. Then came anti-manipulation rules, because a price only means something if it isn't faked on purpose. If traders fabricate volume, coordinate trades, or manufacture fake demand to lure in the public, the market stops being a pricing system and turns into a stage show. A stock price isn't just a number. It's a signal people use to decide where their retirement savings, pension money, and family wealth should go. Mess with that signal and the public isn't investing anymore. It's being played. Then came insider trading rules. Insider trading isn't complicated. It's trading on information the public doesn't have yet. A CEO who knows earnings are about to tank before the market does. A banker who knows a merger is coming. They're not smarter, they're just playing with the answer key. The problem was never that informed people make money. Markets need judgment and people willing to take risks. The problem is that some information isn't earned through research, it's handed to you through your position. If one side is holding the cards while the other side is still betting blind, that's not a market. That's a con. And when ordinary investors believe insiders always know first and sell first, they stop seeing the market as a place to build wealth. They start seeing it as a machine that moves money upward. Then came the accounting scandals. By the early 2000s, Americans watched companies like Enron and WorldCom collapse after years of financial statements designed to look way stronger than reality. Enron buried its debt inside complicated structures. WorldCom disguised regular expenses as long-term investments. The numbers were lying, and when the numbers lie, everything built on top of them lies too. Stock prices, analyst reports, executive bonuses, retirement accounts, public trust. Employees lost their jobs and their savings. Executives had already cashed out. Once again, people learned the rules hadn't caught up to the tricks. Sarbanes-Oxley showed up in 2002 because profits can be pure fiction. It demanded stronger internal controls, more accountability from executives, and real consequences for cooking the books. A financial statement is supposed to be a mirror. In a bubble, it becomes makeup. Markets kept evolving. The old shouting trading floor gave way to algorithms, dark pools, high-frequency trading, and machines reacting to headlines before a human even finishes reading the sentence. In 2010, the flash crash showed just how fast modern markets can break. Major indexes plunged and bounced back within minutes, revealing how speed, automation, and a fragmented market structure could spark chaos faster than the old rules could handle. Circuit breakers became necessary because markets don't just panic at human speed anymore. They panic at machine speed. Every new piece of technology creates new ways to trade, and every new way to trade creates new ways to tilt the game. Which brings us to today. The rulebook still exists, but it's being stretched by new machinery. Private companies stay private longer, reaching massive valuations before regular investors can even buy in, then go public exactly when insiders need to cash out. Passive index funds automatically buy whatever the benchmark tells them to. Prediction markets let people bet directly on political outcomes. Algorithms trade headlines instantly. A single government decision can move oil, defense stocks, and currencies within seconds, and index rules change in ways most everyday investors will never even notice. None of this means there are no rules. It means the danger has gotten sneakier. Rules get reinterpreted, guardrails get quietly loosened, technical language hides massive consequences. The old insider knew a company's secret. Today's insider might know a government decision before it's even announced. The old operator moved a stock with rumors. Today's market moves on headlines, algorithms, and event contracts. The old pool needed newspapers and brokers. The new system has social media, ETFs, futures, and global liquidity. Same instinct, better tech. That's why free market can be so misleading. A market isn't free just because it lacks rules. It's free when people can participate without getting systematically deceived, trapped, or used as someone else's exit. Rules aren't the opposite of markets. They're what makes markets believable in the first place. Without disclosure, you don't have investing. You have guessing. Without margin limits, you don't have stability. You have fragility built on debt. Without anti-manipulation laws, you don't have real price discovery. You have manufactured signals. Without insider trading rules, you don't have competition. You have access dressed up as skill. Without accounting rules, you don't have real earnings. You have fiction with a quarterly call. That's the real history of market regulation. It's not some story about bureaucrats randomly crushing freedom. It's the story of powerful people finding every possible way to exploit trust until the public finally demanded protection. And that's the warning for today. A market doesn't need to become lawless to become dangerous. It just needs enough gray zones, enough complexity, enough private access, enough political information, enough loopholes that ordinary people can't tell anymore whether prices reflect real value or just raw power. History shows that regulation usually shows up after the public already paid for the lesson. After the crash, after the fraud, after the hearing, after retirement accounts got wrecked, after the people who understood the trick had already walked out the door. So, next time someone tells you markets don't need rules, ask them which scandal they're willing to repeat. When someone says regulation kills freedom, ask them whose freedom they actually mean. The freedom of ordinary investors to trust the numbers, or the freedom of insiders to sell them a story before the truth catches up. The stock market has rules because greed doesn't regulate itself. It innovates, it adapts, it hires lawyers, it finds the edge of the rule book and leans on it until something breaks. A market without rules isn't free. It's just prey waiting to get eaten. The question was never whether markets need rules. We already know the answer. The real question is whether the rules can ever keep up with the people who profit from staying one step ahead of them. If this changed the way you see the market, hit subscribe to the Wealth Code. History has the answers. I'll show you exactly where to look.